Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you. It's been an interesting couple weeks, to say the least, with the stock market. It's been pulling back this month, so it's interesting to watch.
Yeah, it's kind of a bumpy ride, a couple of days down by quite a bit, then a little bit of a recovery. Is that people profit-taking?
Yeah, I think so. I mean, but I think all the moves have to be put in context with what has happened and then the big macro picture. But, last year we had that 20% decline in the fall, and we've rallied back up. The S&P 500 made a new high for a couple of days and just peaked out, and now we're pulling back. But the NASDAQ got so overbought on technical indicators such as the RSI that it rarely gets that overbought. The last time something got that overbought was the Dow in 2018 in January. And the key takeaway is when a market gets so overbought, without, having a pullback, which is what happened from December till the beginning of this month, you've got to expect a pullback to happen, or at least some consolidation to work off the overbought condition. So we came in this month like that, and now we are seeing the stock market pull back. And it looks like the S&P 500 is, it's right on 2,800 today. That was the low of the month, and looks like we're now testing it again. If that breaks, then we're looking at 2,750. The question about that, though, is 2 weeks ago, I thought, we're going to pull back, and we'll hit that 2,750. It's where the 200-day moving average is. We should bottom out there, and most pullbacks in the market, this was happening with this trade news, and I thought this might be like Brexit the other year. The market pulled back on Brexit, but when you have the quick pullbacks, you'll see some fear coming in the market. The VIX will spike up, and you'll actually see people even get scared. But that's not been happening at all, and that makes me a little bit worried that this might not end at 2,750, but could go on to lower levels from there, and it might be a slow motion pullback that lasts for a couple months. And it's not what I want to happen, and it's not what very many people are expecting. And really, when we comment as commentators in the market, people want to hear us talk about things going up or something going up. That's how people want to make money. You talk about pullbacks, people get mad, and if you talk about things could pull back more than a few weeks, they get really mad. But if we think about some of the other things happening in other markets, for example, the bond market is soaring. The Treasury bonds made a new high today. Some of the Treasury bond ETFs, such as TLT, 10-year interest rates on those bonds are at the lowest level in years. And the Fed fund futures market is now projecting a 70% chance of a cut by December, 50% chance of one by September. And if that's going to happen, then the stock market would have to drop first for the Fed to lower rates. They're not going to lower rates in the stock market, is at making a new 52-week high. It takes a dip to give them the political capital to lower rates. So the bond market is telling us that there's the 70% chance of a pullback between now and December, and I think we need to take that seriously. It doesn't mean money can't be made in anything, because there are some things outside the Apples and Facebooks and Nvidias and Tesla, my gosh, some of these really fad stocks that can be done, that you can make money in. And so that's really what I got my eye on right now.
We'll have more with Mike Swanson right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Mike Swanson. Mike, do you think Tesla is going to be able to hold on?
I think it's going to go bankrupt. It's one of the two takeaways about Tesla. First of all, they're losing all this money. They lost like $700 million in the last quarter. That's what they revealed in their earnings. That's what sparked the current slide in the stock. And a year ago, Elon Musk was saying they would make profits this year. Instead, they're losing hundreds of millions of dollars a month, which is amazing. But historically, they haven't been able to produce as many cars as they say, and so forth. But they had one of the craziest conference calls last month that I may have ever heard about in the financial markets, period. So what was happening was they were doing a secondary offering to raise money for the company, and Musk claimed that they didn't need the money, that they were just doing this to create I think the word was, he said buffer was the word. In case there's a recession or something, they'll have the buffer. Well, so he said they didn't need the money, and then after they raised the money, he came out and said they've got to cut costs, which indicates that there is some sort of financial trouble with the company. But then he said something really bizarre on this call with potential investors, and that is that, when people think of Tesla, we think of their cars, and people are going to buy these cars, and it's all about the magic of electrical cars, and there's this, fan base for these cars. Well, he said in this conference call that the company is going to now suddenly be repositioned and not going to be about the mom and pop or whoever buying one of these cars, but they're going to start to create automatic driving taxi cars, and that's going to become their new big thing. And the whole company is essentially going to be kind of branded around that. That's what he stated in this call, which is a 360-degree shift in the entire business model of the company. And what's really bizarre is the call's purpose was to raise money in the secondary offering, and the offering documents didn't even say anything about this business about going into the world of self-driving taxis. And I can tell you, I'll never get in a self-driving taxi, and I certainly will never get in a self-driving taxi that is done by Tesla, because these darn Tesla cars, they wreck all the time on their automatic driving. There's a story in Forbes today that there was an accident just last week where there's traffic and all the cars were stopped, and the Tesla car just kept on going and rear-ended someone. So it's a company that is now having a black cloud on it, and it had been a favorite stock for years because it was going up. People were touting it. As long as it went up, it was very exciting for people. I'd see every night almost on CNBC someone would recommend it. But now CNBC did a segment last week, in which they had a lady on there saying that the bonds for Tesla are going down in value, which means that the people trading the bonds see a risk of bankruptcy growing every week, it seems, because the bonds go down in value every week. And she's pointing this out, which is a dramatic shift in the tone and discussion of Tesla on CNBC. And even some of the big brokerage firms are now coming out against the stock. And Kramer made a statement that I agree with, and that is this is now becoming a kick the dog down situation where people are verbally piling on the stock and seeing this as something that's going down the toilet, and they're going to get on the bandwagon of pointing that out, because I think now it's very obvious that this is starting to unravel, and when it wasn't that way for most people 6 months ago. As long as the stock was above 240, people were supporting it on television and elsewhere, but now that it's broken 240, people are abandoning ship, not only the shareholders, but the street itself.
It also looks this might be a dangerous time to have an initial public offering. Uber just kind of crashed and burned. Is it a bad time to get into a market when it's near its peak?
Yeah, it's a dangerous sign when you see these high-profile IPOs come out and blow up. That's something I don't remember seeing that in 2007, but it certainly happened at the tail end of the internet bubble. That's not to say the stock market's like the internet stock bubble back then, but I would take it as a warning sign. However, I'm not myself personally taking the stance that I'm not going to invest in any private offerings because I'm interested in private offerings in the mining sector. And, I know people that are in the marijuana sector doing things. So, I think if you are in special scenarios or something, then it makes sense. But the high-profile public offerings definitely appear to be very risky nowadays.
We'll have more with Mike Swanson right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, the U.S. Midwest has been hit hard by flooding this spring. Does that mean that there could be food shortages and that means higher prices?
Yeah, I think that's what's coming, and for two reasons. One, when I was talking about the S&P 500 and the broad market, looks to me like it could fall for several weeks or months even, in a bigger correction than I was thinking the other week. Doesn't mean I think the stock market's going to crash like 2008 or anything like that. If we just went down to the December lows, we would probably get a big rally afterwards, and the Fed will lower, if the Fed lowers rates, that'll create a big rally. But if that happens, if the Fed lowers rates, commodities will benefit in time, because there's a cycle in which gold and silver go up first, and they appear to ended bear markets in 2016 for sure. And then the soft commodities such as agriculture go up afterwards. And if we think of that cycle, gold and silver bottom in 2016, other metals, but agriculture commodities did not. And agriculture has been in a bear market now since 2011. That's 8 years. That's an 8-year-long bear market, and I can't really think of anything off the top of my head that's been in a bear market for 8 years. So that's historically pretty amazing. So on that basis, I've personally been tipping my toe into getting involved in the agriculture sector through some of these ETFs that hold various agriculture commodities. I'm not playing in the futures market, but some of these ETFs. Now, that said, what you mentioned also could be the catalyst. One interesting thing that happened is this month, most of these commodities had sharp drops going into last week. The biggest drop over 4 weeks in several years for the major commodity index for agriculture. And then some of the agriculture, the ETFs, DBA, that's the one I'm in a position in, which owns most of all the soft commodities, food, meat, and so forth. Then there's a Rogers one, RGA, but both of those fell very sharply in May to new 52-week lows, and it looked to me like a potential panic bear market bottom, something like what happened with gold stocks in July of 2015. They made a new 52-week low and then fell like 10%. It's basically the type of action these things had. And when gold did that in the gold stocks 2015, they jumped right back up a few weeks later. And that's what these agriculture commodities are now doing. So for instance, corn is up 3% today, but there's a corn ETF that was down to below $14.50 just 2 weeks ago, and today it's up to $16.64. That's a return, a huge return in a short amount of time of almost 15%. That's a lot for a commodity. And corn is now above its 200-day moving average, above its 150-day moving average, and above highs seen since October. So it looks like a bear market bottom and a big rally, and several of these commodities are doing that. Even soybeans, which have been so linked to, of course, to the China tariff situation, are up pretty good today. They're up 3% after having a big sharp drop going into this week. So I think there is a potential bear market bottom. And then we got, as you mentioned, the massive flooding in the Midwest. There's stories, anyone can look it up, about just type corn Midwest flooding, and you'll see stories about how the prices are supposed to rise sharply from now on into the rest of the year because there is a vanishing of supplies because of all the flooding and the harm done to the farmers even before the flooding, thanks to the tariff situation. So many farmers went out of business. So there's a tight supply in various agriculture commodities at the same time that we appear to have just had the equivalent of a bear market crash type bottom. So I think it's a very fascinating time to take some investment style positions in these commodities. That's what I'm doing. I'm buying them with the idea that they could actually go up for years in an overall bullish commodity cycle. So I'm not trying to necessarily jump in and out of them. And it could be like the gold stocks where these agriculture commodities have a sharp jump for a couple weeks, like they did in the fall of 2015, and then go back down to their lows or retest them or go sideways or something and then go up again like gold stocks did in 2016. But that's how I kind of like to invest with a portion of my money. I kind of look for things that I think have bear market bottoms and put 14% or so of my money into that type of play across the sector. And this is the only one I'm doing that with now. My thought is at the end of this year, next year, I'll be doing it with some other sectors. I've already done it with gold and the mining stocks. So that's how I have an allocation to them.
Mike, thank you so much for chatting with us.
Oh, it's great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HoweStreet.com radio. Find us on Twitter at HoweStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.